Welcome to the podcast Selling Real Estate with Kelly Cook, where we will discuss the latest and most relevant business strategies to help you do one thing extremely well: sell more homes. We'll discuss everything from business planning to lead generation and conversion to past client customer service and everything in between. Join us for authentic conversations and nuts and bolts takeaways you can implement into your business today. And now, Selling Real Estate with Kelly Cook.
Welcome back, everybody. It is another great day and another episode of Selling Real Estate with Kelly Cook. Kelly is here with us, of course. How are you doing today? Are you having a great day?
Man, I'm having a great day, but they're all great days, right, Elizabeth? They're all great
Of course.
days. You know, I had this conversation with my kid this morning, my son, who's 9. He literally was having a little meltdown about a project that he didn't think he was doing good enough on, which I respect. I think as a parent, all of us can a little bit, but then he had his face down the couch and I was like, thinking to myself, this is not a good way to start the day off, right?
Yeah.
He's going to go to school. It's going to cascade. I know how it works because we've been around longer than our kids. And I just told him, I said, hey, look, you know what? You're in control. I know you're not feeling good about this right now, but like it's going to cascade. And we have this talk in sports. In sports, is this talk about having a short memory, right? If you mess up, because it won't help. It's already over. It won't help you with the next play, but it will help screw up the next play. And so I had the conversation with him about school today and mentality, and it was great. And I don't know if it set in. I have no idea because his face is buried in the couch, and I was just gonna let it go. But I was like, hey, it's your choice. We want to have a good day at school today, right? I do affirmations with them sometimes, and he's like, and so it's your choice. You can choose to be upset about this. I know it stinks. I empathize a little bit, which is hard for me to do sometimes. But your choice. You can turn this around and make this a great day. But you are in control, whether you are right or whether you are wrong. Either way, you're right. Right?
Yeah, absolutely.
Whatever you believe. So anyways, yeah, great day.
No, that's great. Yeah. To add to that, I have kids that are a little bit younger, 4 and 5. And we're having this conversation. It's a little bit different, more than, but it's your choice. You are in control of yourself. We have to use it with hitting each other when, oh, she made me do that because she took this away from me. She did not make you do that. You're in control of your reaction. So hopefully your kids are out of that stage, but mine aren't. So we have to have that same conversation, though, of you are in control of your actions. You can't control what other people do, but you can control your actions and your mindset about it. So absolutely. So, and this is still a great lesson, not if you're 4 or 5 or 9. But I think that's a good lesson that we all need to remind ourselves a lot of the time. So, but that is not what this podcast is about today. Sometimes we talk a lot about mindset and things like that. I'm sure we'll have another episode like that coming up. But today we're talking about some technical stuff or some real world implementation that you can use as a tool to kind of going back to what we've talked about a lot on this podcast. Be the resource for your client. You don't necessarily need to have the answer to all of the problems, but know where to find that answer, right? Kind of point them in the right direction. So we're going to go back to that today, and specifically about HELOCs in a way that Kelly something that he wishes he knew about a long time ago. So go ahead and be that person. I mean, we'll inform you and make sure that you pass that information on so that you can be that source for your clients. Kelly, let's get into it.
Yeah, definitely. There's that old saying, right, that says the teacher appears when the student is ready. And I say that because I heard about this to a degree. I chose to remain uninformed and not dive in on it. And that's to my detriment, I think, at this point. But I'm not going to miss this second go around of having this come in front of me and then understanding what it is and choosing to ignore it. Once you see it, you can't unsee it. And I chose to dive in on this one. So guys, this will be a good one, whether it's for yourself personally or for a client of yours. And so did you know that in many countries across the world, a 30-year fixed mortgage does not exist? It's not really an option. And if it is, it's not one that people take advantage of much. Because I think we all know that that the majority of interest is paid up front to a bank, right, over the life of the loan. And that's how the bank obviously makes their money. And then on top of it, they want you to refinance at some point, right? If rates drop a little bit, you refinance and start the clock all over. So sidebar, did you know that when you refinance, if you're, say, 4 years into your 30-year fixed mortgage, Did you know that you can refinance that point for a 26-year mortgage? So the clock isn't fully reset. You can. A lot of people are not aware of that. That's not what this podcast is about. But I wanted to just get that out there, right? So because the interest is paid all at the front, it's front loaded, you are going to pay a ton of money. Now, if you ever see your documents when you sign them, the loan documents when you buy a house, there's this truth in lending disclosure, and it tells you right there over the life of the loan what you're going to pay. Now, I've seen this before many a times. I own multiple houses, but yet,
Kelly, you were like, for a couple of minutes there, or a couple of seconds there, you were like frozen.
oh, really?
Yeah. Um, so I don't know.
I'm hardwired in here. Huh.
Yeah, mine
Interesting.
says it's okay, so I don't know. I don't know what that was, but if you want to
Where
go
should I pick up
back
at?
to you were saying that you don't have to have the clock start all over. You can get like a 26-year mortgage. That's
Okay.
kind of right where
Like
it
sidebar
started.
of sidebar. Okay.
Oh yeah, sidebar. Yep.
All right.
And yeah, cut,
All right.
go back. Yeah, I'll make sure I get all these timestamps.
Okay. All right. Here we go. Here we go. So sidebar, did you know that if someone refinances and you've already paid 4 years down on your 30-year fixed mortgage, as an example, you can refinance for a 26-year mortgage. That is possible to do, but a lot of people don't know that. They're uninformed, and I think even though it's legal and it's true and all these things, a lot of the powers that be, if you will, probably don't really want the average person to know about it, or the majority of people to know about it, right? Because then they continue to make more money on
They want it
interest.
as long as possible.
Yeah, exactly. So, okay, we're not going to get into a conspiracy theories on this. That's not the point of this. The point is that's what's happening, and a lot of people love it. Now, there are a lot of great things about a 30-year fixed mortgage. It makes the housing a much more affordable, and it gives people stability on their payment. Especially, it's a great hedge against inflation. We've all seen what happens with inflation, and how expensive things have gotten in the last couple of years here in America. So, having a 30-year fixed payment is a great inflation hedge, right? But let's say you want more than that. So that's like, step two. That's great. You guys, you're doing very well if you're not renting and you actually own a property when things are highly inflated, because your equity increases too. However, there's a better way, guys. I'm telling you. I didn't know about this, but I'm jumping in on this, and that is a first position lien HELOC. Okay. Now, I am not an expert on this. I can get you in touch with some people that are, but I know enough to be dangerous enough to wet your whistle to maybe wonder if this is right for you. You literally can, if you have a mortgage on your house, you get a HELOC, a home equity line of credit. Now, this can be up to 85 to 90% of your market value, appraised value of your house today. And you can refinance, so to speak, out of your current mortgage into a first position rate HELOC. Now, the first question I'm going to get for somebody is like, well, hold on. Rates are really high. That doesn't make sense, right? I mean, I have a 3.5%, I have a 2.5, I have a 4% interest rate
Yeah.
on my 30-year fix, whatever. And now if I go to HELOC, it's going to be 9%, 8.5, whatever, right? And that is absolutely true. So why in the world would you be talking about this right now in this interest rate environment, Kelly? I'm glad you asked, because at the end of the day, don't get mad at me. Don't get mad at your loan officer. Don't get mad at the guy who's selling, this first position lien HELOC product. Do the math. Run the numbers yourself. Don't take my word for it. Run the numbers yourself. At the end of the day, it's mathematics. Mathematics are true. They are black and white. And if the math is there, the math is there. And so trust, but verify for yourself. But let me continue to wet your whistle on this, because what this will do is potentially knock a 30-year repayment schedule of paying off your loan down to potentially as low as 4, 5, 6, 7, 8 years. Yeah, this is not making one extra principal payment a year and being on the acceleration plan that your lender can offer, which, by the way, that's a great idea, right? That would knock it down usually on average from like 30 years to like 23 years. This is completely different way of doing business. Now, so let me give you a diagram of this verbally so you can have an idea of how this kind of works. So what happens is you get a first position a HELOC on your loan. Let's say your house is worth $500,000. I'm going to do some math. Now, if you're at 20% LTV, that's $400,000, right? If I grab a calculator, and I think they go as high as 10%, let's do 15. So if you have a $500,000 house, that's what's worth today. You have some sort of mortgage on it because you put some money down when you bought it, let's say, or maybe you have some equity in the property that above and beyond your down payment, and you do 0.85. Okay, that is $425,000. Now that would be the approved amount you would get on your HELOC. So let's say you owed 385 or something like that, something less than 425 on your current mortgage, right? Then you would refinance the HELOC. The HELOC then pays off, okay, that existing balance of your current mortgage. And now you have a HELOC in place as your mortgage in first position at, yes, 8.5, 9%. Correct. Understand this is simple interest. This is not an amortization calculator, amortization schedule. That is the difference. Okay.
Yeah.
And then there's this thing called velocity banking that is the plan, is the program that you incorporate with this vehicle, which is called a HELOC, home equity line of credit. And you have this magical mathematical computation that kicks up and is a enormous avalanche running downhill. And so what happens in theory is you have income coming in, okay, that you earn from your job or whatever you do for work. And it could be rental property income. It could be, you're a garbage man. It doesn't matter, right? You're a teacher. Yeah. Income comes in. And normally we deposit that in our bank account with Chase Bank or Wells Fargo or Bank of America, right? Well, instead, what you're going to do is you're going to use the income that you have left over, assuming you have some disposable income after your expenses. So either A, you got to choose how to make a few extra bucks to be above your expenses, or B, you have to choose to live on maybe a little bit tighter of a schedule when it comes to expenses, right? It's one or the other because you have to have some extra additional disposable income. That could be $100 a month, it could be 500, 1,000. Anything will perpetuate this and make it go faster than a 30-year fixed schedule. Okay, so that income comes in, you get extra income after you pay all your expenses. Then will go into your your income comes in and you dump it into your HELOC. Okay, now your HELOC has a separate bank account. It's called a sweep account. And so you put the income into your sweep account, and a lot of these places that specialize in these first position HELOCs, then they have automation technology in the background going on where your HELOC at midnight every night sweeps that money, the income that you put in there from your paycheck into the HELOC. And if your balance in HELOC is $425,000 and you put $2,000 of income in here, now your balance in your HELOC the next day is $423,000. Okay.
And that happens every day? You said every day at midnight?
It's every day at midnight sweeps it, but it
okay.
only takes down the amount of the HELOC if you have income sitting in that account that you deposit from your paycheck, or you get a commission check, whatever, right? So that goes in there and it takes it down. So now your HELOC's sitting at 423. But the cool thing is now, instead of having your expenses being paid out of your normal Wells Fargo Chase account, now you have your expenses paid out of your HELOC account. Okay, so let's say now you have a water bill. Water bill is $100. Water bill gets paid instead of the automatic bill pay coming out of your Wells Fargo. Automatic bill pay now comes out of your HELOC bank account. Yep. And so now you have your account is negative because remember it swept the $2,000 you put in there, paid down the balance, and now your account over here is negative by $100 because it just paid the water company. And so the very next day, because it sweeps it every 24 hours, the HELOC will add $100 back into your account so that it's back at zero. It's a zero balance account every single 24 hours. And using the mathematics of simple interest, having your HELOC be paid down here, and then a little bit is given back, then pay down more, a little bit given back, pay down more, a little bit given back to pay expenses, right? And this cycle, this velocity, this flow of money actually accelerates incredibly.
Yeah, because you're not even thinking about it. Like
you're not even thinking about it. And it happens now. Some banks don't. A lot of banks are just other bank, Wells Fargo, Chase. They probably aren't going to have the ability to do the automation right for you every 24 hours it sweeps. But these companies who specialize in this, they are also banks, and they have that automation that's free of charge with the HELOC account. Guys, I'm sitting there going, what in the world? Now, who it's not for? Who it's not for is somebody who is not disciplined with their spending habits. Who it's not for is somebody who doesn't like to manage their money somewhat actively. Now, with the automation there, you don't have to manage it that actively, but you still have to you have to pay attention to it, right?
Be aware of what you have in there.
Be aware. Yeah. And it is a little we aren't used as Americans to doing this because we're taught the moment that we get into the working force and we're maybe going to be a potential homeowner, the way you go about it is you get a mortgage and you do the 15, 20 year, 30 year, whatever fixed it may be, and away you go. And so this is not this is not the forefront of the financial gurus, minds, obviously the banks, because they want you to pay a 15, 20, 30 year because they make more interest that way, they make more money that way. But all it is taking money and moving it from account to account and using the mechanism of simple interest principal buy down, you end up paying an incredibly amount of less interest on your mortgage for the time period you own it. So if you paid off in 7 years, your interest payment will be a fraction of what it'll be over the course of 30 years, even with your interest that you are paying being at 8.5 or 9% compared to 3%. So, like for example, in my situation right now, I'm looking at it because I'm literally sitting there going, "Whoa, this is crazy." I have a 15-year mortgage on my current house, and my rate I think is 2.75. So most people be like, "You'd be crazy to get that up." And honestly, like that is an incredible situation because I obviously restructured this back when the rates were really low, back in the post-COVID era, etc. But the math is the math, and the math says that doing
You're
this
gonna
type of
save money.
situation with 9%,
Yeah.
it's not even close, not even same ballpark in terms of comparison. So, anyways, guys, that should be enough to wet your whistle. Now, you cannot do this on rental properties. There could be some banks out there, that specialize in this that potentially will do it on rental properties. But the couple banks I've talked to so far don't. They had before in the past, but then with COVID and the risk to the bank, they decide not to do that. However, if you find someone that you like, but maybe they don't do that, you still have the ability to do it on your rental property if, say, you buy down your HELOC balance far enough to where you have plenty of equity on that HELOC that you can write a check to maybe pay for rental property cash, right? And then you do the same thing through the rental property, right? It's just attached to that asset. So it's pretty crazy, guys. And again, I heard a little bit about this in the past years ago, and it was interesting for about a week, and then I just didn't do anything. And I wish I would have. But I think this time around, I just got to verify the amortization schedule. They give you a calculator. It says, and I look at it and go, holy cow. But this was as literally this morning that I got it from my specific situation. So I'm going to look at it and I'm going to just verify that the math is right, which I'm sure it is. And then if it is, it's a no-brainer.
Go for it. Yeah.
So, yeah.
Is this something that, because I've heard different things about, if you're in your starter home and you're not planning on being there for the long term, really don't worry about paying too much more towards your mortgage, even though that comes back to you in the end when you sell and all the things like that. But is this something that you would recommend for people who aren't planning on staying in their house long term, maybe 3 years, 3 to 5 years? Is this still, does it still make sense for that? Or would you say that this is something that's more when you're in your longer term home, like 10, 15 years, whatever you're going to be in? Or does it make a difference?
No, it does not make a difference. I would recommend to anybody who owns a home, no matter what age group you are, to look at having a first position lien HELOC be your mechanism that you use for the debt instrument on your house. Because even if it accelerates your repayment schedule from 30 years to 8 years, and you sell, say, in 3 to 4 years, you still have this balance
More
that was
equity.
completely bought down because you just flat out paid a lot less interest. The interest rate was triple potentially what your 30-year fixed rate is. That's the crazy part. It's not about the rate. It's about the buy down of the principal balance and paying less interest. Why? Because the interest is calculated off the principal balance. So if your balance is naturally lower every month, then your interest will be lower too. And therefore you pay less as a sum total, and then you can
over whatever span of time.
Over whatever span of time. And you potentially now have that room to where, I don't know whether you paid off or not, you have that room on your HELOC that you have sitting there that you can use for whatever else you may want to use, as long as you are still, have it open. So it's incredible. If someone just takes the time to explain that, I think, and you're listening and going, wow, that doesn't seem that complicated. No, it doesn't. And the fees associated with doing the refinance is not that expensive either. Very reasonable. It completely along the lines of what it would be from a normal lender to refinance you right now.
Yeah, absolutely. Well, guys, if this is interesting to you, Kelly knows quite a bit about it, not all of it, and he probably knows some people who do. But Kelly, where can they reach you to learn a little bit more, or where you can send them off to learn more about it? Where can they reach you?
Yeah, absolutely, guys. Hit me up on social media, Instagram at Kelly Cook Homes. Love to connect with you there, or text me 480-227-2028.
Yeah, and as we said before, this is a great thing not only for yourself, right? Take advantage of this yourself, for your own home. Can do it for rental properties, but for your own home, or this is a great way again that you can be a resource to your clients if they are in situations where this makes sense, or it's just another kind of option that you can present to them, so that you truly are kind of that go-to person for all things real estate, right? Which is what you want to be. But yeah, Kelly, reach out to him if you have any questions about that. Kelly, what's your Instagram so that people can reach out to you there? You'll always share that. You didn't this time. So where can people go check out your Instagram?
Yeah, it's at Kelly Cook Homes, Instagram.
Easy enough. Go check
Easy.
that out. I know that we talked about social media I mean, we've talked about it a lot on this
Yeah,
podcast. I think one of our last episodes, we talked about some specific social media strategies. Go on over to Instagram, see what Kelly's doing there. And other than that, we will see you guys all next week with some new stuff for you.
sounds good.
Bye, Kelly.
See you, Elizabeth.